Earlier this week, the Bank of Canada hit that pause button. Now, does it mean that the Bank of Canada is going to pause indefinitely? Are they going to cut rates in 2024 or remain on hold indefinitely? This week, we're going to talk about that. Welcome back to the channel. It's Friday, Finance Fridays, and I'm your host, Anthony, with InTouch Mortgage Solutions. And yes, this week, the Bank of Canada did meet to talk about their monetary policy report, their recent decision to hold monetary policy at 5%, and what it means potentially for the real estate mortgage marketplace as we digest this data. A lot of economists right now are talking about a Bank of Canada that has no choice but to cut rates in 2024 as they believe they've over-tightened. And then there's many economists who believe that the Bank of Canada is still open for a definite increase at some point, either by the end of this year in December or in 2024, while many others believe that the Bank of Canada has to stay on hold, at least for the foreseeable future, as we enter into some major geopolitical issues. Now, obviously, this data is important for Canadians, especially for those looking to emerge and purchase a home or maybe get into the real estate market, and for Canadians that are looking to renew their mortgages as we are in a higher rate environment. And these are all conversations that are being discussed by the Bank of Canada. So starting off with the Bank of Canada's most recent policy report, there are two major changes that we should be paying close attention to in order to maybe formulate a better opinion on whether or not the Bank of Canada has to hike, pause, or hold rates. So looking at those two decisions, one is the growth in the economy. What is happening right now? GDP per capita, what is happening with consumer spending? And if we look at the modeling that the Bank of Canada is indicating that's changing, right? They're basically reshifting their focus on growth down from where it was just in the July monetary report because they see the economy is definitely getting weaker. We're seeing less growth, less spending in the economy, something we've talked about. And we have to be very cautious that there's less spending happening in an economy, means Canadians are spending less each and every month than they were in the previous month. So we're seeing that growth level come down. And we also have to factor in that we have something that's very different here in Canada than in the US, and that is our immigration levels. Here in Canada, we're bringing in hundreds and hundreds of thousands of new to Canada individuals, whether they be students, work permit, permanent or non-permanent residents. There is a huge influx of immigration. And although it is needed to replenish the aging population, as well as create new tax revenues for the government, it is important to understand that as these individuals arrive, they are going to be consuming. And when we look at the data showing that the consumer spending patterns are actually declining with more people entering the country, it is literally problematic. And it signals, at least to me, that we are definitely in a recession. Bank of Canada, I believe, is acknowledging it by not saying it, but by changing their forecast, basically saying that we're going to get to 2.5% growth by 2024 or 2025. But right now, we're probably around 0 to 1%. And these are some really staggering numbers, especially with higher immigration levels. Let us know what you think in the comments section. But the other move is the direct impact to inflation and the timeline, the duration by which we're going to get to 2%. Now, we've talked about that the Bank of Canada has changed their forecast to get to 2% by 2025, but the path to get to 2% is going to be a little bit more rocky than maybe what they have thought. So they're isolating that, look, there are some major issues that we could be facing, not only here in Canada, but obviously in the US, and more importantly, globally, that could sort of impact us getting to 2% faster. Now, these are very important factors, I think, that should not be overstated or understated because of the fact that the geopolitical issues that are rising not only in Russia and Ukraine, but also in the Middle East between Israel and Palestine, because those conflicts, if they bring in oil-producing nations, well, what does it mean to oil production, oil, gas, energy, especially here in Canada as we enter some of those colder months and some of our provinces that still run on oil to heat their home? Well, what does it mean for these Canadians? And more importantly, what does it mean for us as consumers who need their vehicles to get to back and forth to work? So this is a major touch point for the Bank of Canada because they've even modeled into their expectations that oil and energy prices are going to be on the rise in 2024. So they know, or they're at least anticipating, that there could be some major changes to energy pricing in the future. And then the other component could be if conflicts arise between China and Taiwan, what's happening in Asia, because we understand now that supply chain disruptions can be inflationary if we don't get the goods and services or the goods to do some of the services to help the Canadian economy. If those are disrupted, then what happens to the price, that balance of supply and demand? So this is obviously another conversation when you listen to Governor Tiff Macklem. He's talking about monetary policy. So monetary policy is the overall theme, I believe, to get from the Bank of Canada's most recent conversation, at least from my perspective, because they've increased policy rate so drastically over the last 24 months. As we get to 2-year anniversary in March of the first increase in 2022, we've seen policy rate go from the 0.25% to 5% in a very short duration. It is a very high probability that these monetary policy reports, or the higher probability on the monetary policy decisions, especially the last two in June and July, the last 2 quarter bumps that we saw, have yet to play into the economy. They have yet to be actually digested, as monetary policy generally takes anywhere from 12 to 18 months for it to be felt in the economy. Remember, these decisions work on a lag, and right now we're starting to see those cracks form. And the Bank of Canada is acknowledging that, look, monetary policy is working. We should take a step back and pause right now to see if they've over or under tightened.
We held our policy rate steady today because monetary policy is working to cool the economy and relieve price pressures. And we wanted to give it time to do its job.
So these are some of the conversations that are happening now. And I believe the Bank of Canada is at a position right now, or a crossroads, where they need to pause, at least for December, to really see how these numbers play out. Now, we are entering probably one of the busiest consumer seasons in the year, obviously during the holidays. So we'll see how those data numbers play out in January, but it could be a blip. We could be seeing maybe some employment tick up a little bit as seasonal jobs sort of kick in and more Canadians looking for part-time work to help make ends meet. Obviously, this data has to be provided, but maybe the Bank of Canada will look through that data because they understand that those things particularly. Now, one important thing that's brought up by some economists, and I tend to agree with them, is the language the Bank of Canada is using at the current moment when they talk about hawkish, a hawkish pause, hawkish meaning very aggressive language that, hey, the Bank of Canada is prepared to raise rates if we need to. Yes, the Bank of Canada does need to signal to the markets that they're trying to be very affirmative in their actions. However, the Bank of Canada might know that they're already at a point where they cannot raise rates any further, and that's what some economists are arguing. So they're using the language to put a lot of fear into the market, as well as to deter markets from turning over, especially the stock, bond market, and more importantly, the housing market. If they use this aggressive language, do not make that mistake like they did back in 2020 when they said, hey, interest rates are going to be lower for longer, so go out and blow your brains out and over leverage yourself. Now, although there's a different conversation there, the Bank of Canada is going to be very cautious on their language going forward. So they just don't want to signal to the market that maybe they're done. Because imagine if they did come out and said, hey, we're done raising rates, we're going to be cutting in 2024, holding. Imagine how that would be received by real estate investors or Canadians looking to go out into the market, Canadians looking to refinance their mortgage. Maybe they're going to wait. It's going to have so many different impacts. So the Bank of Canada is, I guess, holding back on their language. At least I believe that that is the case. We could argue differently, but I believe the Bank of Canada is going to be very hawkish. They don't want to signal that they're done right now. Let us know if you agree or disagree in the comment sections below. Now, last but not least, obviously we have to talk about the housing front. It's in the monetary policy report. They're basically talking about higher interest rates, how it's impacting Canadian spending. We know, according to the CPI data, those core inflation numbers, mortgage interest costs are around 30% of spending or cost in the CPI numbers, right? It's definitely elevated, and many Canadians are feeling these pressures. Many Canadians who are approaching mortgage renewal are aware that interest rates are elevated. It's going to cost them more when they renew into that higher rate. How much it's going to cost them depends on the rate that they're going to get when that mortgage hits renewal. But as of right now, as we round out 2023, if you got a mortgage in 2019 and you took a 5-year mortgage, well, you're going to be approaching renewal in 2024. So get ahead of that if you have or you are in that situation. But as these mortgages renew much more rapidly, billions and billions of dollars of mortgages and thousands of mortgages renew, the Bank of Canada is modeling that, hey, these hikes, these bond yields, these higher bond yields that are coming out of the US, they might be doing some of the work for the Bank of Canada. They've argued, the Bank of Canada said, no, it's not going to be a major data point, but it's hard to argue that it's not, because if the Bank of Canada is saying, look, we want consumer spending to pull back, and you have higher bond yields, which are in turn causing higher fixed rate mortgages for those Canadians that are going to renew those mortgages, and it's going to take a lot of steam out of the economy, how does it not impact your decision, or how does it not manipulate your decision to change that course, right? And I really think the Bank of Canada, they don't want to really say it, but I think it's a very important factor because, hey, going from rates that were 5, 5.5 to 6, 6.5, 7, huge number, especially if these bond yields in the US continue to move upwards and onwards. And even the Deputy Governor of the Bank of Canada talked about mortgage affordability. Mortgage affordability in Canada is horrible. It's absolutely disgusting. And they even talked about, obviously, more supply that is needed. But, we have these supply constraints because builders aren't building. Cost of finance way too expensive. There's so many different headwinds against building. But even the Bank of Canada is acknowledging we need more supply. Interest rates alone are not going to solve the problem on housing affordability. And this is coming directly from the Deputy Governor of the Bank of Canada. Here, take a look.
Normally, house prices move pretty lockstep with interest rate increases. As interest rate increases, most Canadians buy houses with credit, so they're one of the first things that respond to monetary policy. As interest rates come down, house prices will move up a bit, and they'll come off as interest rates come back up. We haven't seen that same dynamic. They've come off a bit this time, but we're not seeing, relative to the degree of rate increases, we're not seeing the decline in house prices that we would expect. That really comes down to the thing that we've talked about many times, which is there is a structural lack of supply in the Canadian housing market. So really, until we address that supply issue, interest rates on their own are not going to help us get back to a housing affordability situation or solution. So, we're really pleased to see the degree of focus that governments are putting on this issue right now. That'll help if we can address that sort of structural imbalance. Not only will that help housing affordability, it'll help inflationary pressures too. So it's one of the things that's kind of getting in the way of progress. Your second question, we are paying really close attention to the mortgage renewal cycle. It's one of the things the governor just talked about a few minutes ago. It's one of the things that, is basically it's monetary policy at work. As more households renew their mortgage at a higher rate, it puts, downward pressure on spending. They have less money available to spend on other things. That dampens demand. That sort of gets the economy back in balance. We are watching for the financial pressure that comes with that. We usually talk about that more in our financial system review. We've got an update to that coming in November, and you'll hear more from us on that.
Okay, so with that being said, obviously now we've talked a little bit about different fronts. The last one is the government spending, and that is a major sore spot for the Bank of Canada. And now in November on the 2nd, we're going to get the fall economic report from Chrystia Freeland, the finance minister here in Canada. The Bank of Canada is really pointing to, hey, government spending is a problem for monetary policy. So you have fiscal and monetary policy. Fiscal is government, monetary, think of the Bank of Canada, interest rates, inflation. So government spending, what they're doing to bring in new programs, new incentives, new initiatives. We need to see that government, our current government, pull back a little bit of austerity, a little bit of rebalancing that budget, so to make the Bank of Canada's job a little bit easier when it comes to making those policy rate decisions. And if the government finally caught the play, well, we might see a more balanced budget with less spending or less deficits. And if you subscribe to the ideology of Milton Friedman, very renowned economist, looking at his perception of how inflation works, government spending. If we run a deficit, if we spend more than what we bring in taxes, then we're going to run into a problem. And then obviously the cost to renew these deficits, because the banks, like Canadians who borrow on mortgages, Canada, the government has to renew these bonds at higher rates. So it's going to cost them more. And how this will play out, do you think that we're going to get a balanced budget in November? We'll talk a little bit more about that economic report right here on the channel. So if you're interested to find out our thoughts and opinions on it, make sure you subscribe, you hit that notification bell, so when we post that video, you can get notified about that and other videos when we talk about the Bank of Canada. Now, to end off, obviously the last piece is the numbers when it comes to the US and Canadian dollar. Over the last week, as we've seen the Bank of Canada hit that pause, there's been a huge sell-off in the Canadian dollar. We've seen the US dollar rise. And obviously this has an impact on inflation, because as the spread between the $2 widens, that means we're buying items at a higher price when you think about the exchange. But obviously what it means for the Canadian economy, right? Are we looking at importing inflation? Is the Bank of Canada going to stay as very close to the US Fed policy rate as it is here in Canada, right? What's that gap? And, those are some of the questions that are coming out right now. But the US is projected also to hit that pause button for November. We'll see exactly how that plays out. But overall, I think with all the uncertainty, these geopolitical issues, whether you think about them as inflationary or uninflationary, obviously what it causes when these countries go to war, government spending, what do you think it means for the Bank of Canada? Will they continue to hit that pause button? Will they have no choice but to hike rates with concerns and issues that are out of their control? Or will they have to cut rates based on the economy moving forward? So I want to hear from your viewers. What do you think the road ahead is for the Canadian economy? Are we going to see a Bank of Canada hit the pause button indefinitely? Are we done? Are we going to see rate cuts in 2024? As some of these earlier this week, the Bank of Canada hit that pause button. Now, does it mean that the Bank of Canada is going to pause indefinitely?
Remember, if you
are they going to cut rates in 2024 or remain on hold
button, hit that
indefinitely?
And
this week we're going to talk about that. Welcome back to the channel. It's Friday, Finance Fridays, and I'm
we'll leave the video here wishing everyone a
wonderful
wonderful Friday.
And yes, this week the Bank of Canada did meet to talk about their monetary policy report, their recent decision to hold